what if I told you that you could bet on a stock's future without ever having to buy a single share? Well, that's the powerful and sometimes kind of risky idea behind financial options. At its core, it's all about having the right to do something, but not the obligation to do it. And in this explainer, we're going to break down exactly what that means.
So, picture this. You are absolutely convinced a company's stock is about to go to the moon, or maybe even crater. The thing is, you don't really want to shell out thousands of dollars to buy or short the actual stock. So how can you make that bet with a little less skin in the game? Well, that's where financial options come in.
Okay, let's take a look. What you're seeing here is basically a menu of bets on Amazon stock from back in July of 2020. You've got dates, you've got prices, lots of prices. And I know at first glance it might look a little confusing, but trust me, by the end of this, you're going to be able to read this thing no problem.
Now, before we can order from that menu, we got to learn to speak the language, right? And in the world of options, it really all boils down to two key terms you absolutely have to know: calls and puts.
Let's start with a call option. Think of this as your optimistic bet. When you buy a call, you're buying the right, but hey, not the obligation, to purchase a stock at a price that's already locked in. We call that the exercise price. So, long story short, you buy a call when you think a stock is going up.
And you guessed it, on the flip side, we have the put option. This is your pessimistic bet. A put gives you the right to sell a stock at a pre-agreed price. So you buy a put when you think a stock's price is headed down. It's a way to potentially profit from its decline.
You can almost think of it like a seesaw. For every single option buyer who gets a right, the key to a potential profit, there's a seller on the other side of that trade who takes on an obligation. If you buy a call, someone else is now obligated to sell you that stock at your price if you want it. This balance, this push and pull of rights and obligations, that's the very thing that makes the entire options market work.
All right, so we've got the lingo down. But how does this actually translate into making or losing money? Let's walk through a real-world example to see exactly how the payoff works.
So we're going back to our Amazon menu. Let's say you decide to buy one of those call options. The exercise price is set at $3,100, and the cost to buy this right, which is also called the premium, is $395. You've just placed your bet that Amazon stock is going to rise above $3,100 before this option expires.
So, fast forward. The expiration date is here. Let's see how your bet played out. If Amazon stock is below or even right at your $3,100 mark, your option is worthless. I mean, why would you use your right to buy a stock for that much if you could just get it cheaper on the open market, right? But if the stock price shoots up to $3,600, your option is now in the money, and it's worth $500, which is exactly the difference between the stock price and your exercise price. But, and this is a huge but, value is not the same thing as profit. Remember that $395 you paid for the privilege? We got to subtract that cost. So even though your option is worth $500, your actual net profit is just $105. This is so important. The stock didn't just have to get above $3,100, it had to climb all the way past $3,495 just for you to break even.
Okay, let's flip the script and look at the other side of the bet. Now you buy a put option. It has the same $3,100 exercise price. This time it costs you $387. And you're betting that Amazon's stock price is going to fall below $3,100.
And just like you'd probably guess, the payoff is a total mirror image. If the stock price is way up at $3,600, your right to sell at $3,100 is completely useless. But if the stock price tanks and goes down to $2,600, now your option is worth $500 because it lets you sell a share for $500 more than it's actually worth.
Okay, so we get how the payoff works at the very end, at expiration. But what about all that time before then? What gives that option its value, that premium you have to pay up front? What exactly are you buying?
Well, it really comes down to a few key principles, and the most important ones are time and volatility. See, an option with more time until it expires is more valuable because, hey, there's more time for the stock to move in the direction you want it to. And an option on a more volatile, unpredictable stock is also more valuable because there's a greater chance of a huge price swing happening. This table right here, this is basically the cheat sheet for what makes a call option more or less valuable. And it makes perfect sense, right? If the stock price goes up or you have more time on the clock, the option is worth more. If the stock is more volatile, meaning bigger price swings are possible, that also increases the value.
The only thing on this list that makes it less valuable is raising the exercise price, which just makes your target harder to hit. It's a pretty clear set of levers that determines the price of that promise.
Now here's the cool part. This whole concept of a right, not an obligation, isn't just for betting on stocks. No way. Once you know what you're looking for, you'll start to see that options are kind of hidden in all sorts of financial and business decisions.
For instance, whenever you hear about executive stock options, yeah, those are really just long-term call options that get us part of their pay. Or a warrant that lets an early investor buy shares later at a fixed price. That's an option. Even really complex things like bonds can have options built right in, giving the owner the right to swap it for stock, or giving the company the right to buy it back early.
So after all of these examples and charts, it really all comes back to this one simple, powerful idea. This is the whole thing right here. An option gives you a choice. It gives you potential. It's a right you pay for, but it's an action you are never, ever forced to take.
And that leaves us with one final and pretty crucial question. In the hands of, say, a farmer, an option can be an incredible tool to protect against fallen crop prices. But in the hands of a speculator, it can just be a pure gamble on where the market's headed. The instrument itself is the same. It's the intent that changes everything. So are options a vital tool for managing risk, or are they just a sophisticated casino? The truth is, they're both. And understanding that difference, that's everything.